If you hand me a bucket with a hole in it, I won't argue about whether the hole is big or small. I'm just not pouring my water into it. Money works the same way. Every currency, the dollar, the euro, the yen, leaks. Not all at once, not with an explosion, but slowly, quietly, every day. A little drip of purchasing power gone with each rising price, each new government promise, each printed bill that says, "In God we trust," but buys less than it did last year. And most people never notice the hole. They just keep pouring more hours, more effort, more faith into something that can't hold value forever. This story isn't about panic, it's about preparation. Because money doesn't disappear when a currency weakens. It moves to people and to assets that know how to hold on to it. Gold, land, commodities, businesses, and a few quiet tools that don't make headlines, but outlast them. You don't need to predict the storm. You just need a better bucket. And in this journey, I'll show you where value hides when paper starts to leak, and how to build wealth that doesn't wash away. Gold has a strange kind of silence. It doesn't earn interest. It doesn't grow. It doesn't innovate. It just sits there, cold, heavy, and timeless. And yet, in every crisis, when faith in paper begins to tremble, people run right back to it. That's because gold's job isn't to make you rich. It's to make sure you stay rich when the rules start to bend. Think of it like salt. You don't build a meal around it, but take it away, and everything else starts to taste wrong. Currencies are promises. Governments print them, manage them, and sometimes even abuse them. But gold is a promise kept, a contract written in atoms. You can't print more of it. You can't vote it into existence, and you can't quantitatively ease it with a mouse click. That's why in times of inflation, when confidence cracks, gold doesn't have to rise. It just has to not fall. While paper burns, gold stands still, and that stillness is power. But don't romanticize it. Gold isn't a miracle worker. It won't pay your rent or fund innovation. It's the fire extinguisher, not the fire. You don't worship it. You don't hoard it. You give it a small, dignified corner in your portfolio, just enough to matter, never enough to depend on. Because when paper forgets its value, when markets panic, when politicians reach for the printing press like it's a life raft, gold simply waits. It doesn't panic. It doesn't promise. It reminds. That wealth isn't faith. It's something real, something earned, and something worth protecting. Gold won't build your fortune, but it might save it when the world forgets what money means. They say money doesn't grow on trees, but food does, and so does value, if you know where to plant it. Farmland isn't glamorous. It doesn't light up a skyline or trade on a stock ticker. It's quiet, patient, and honest, a living engine that turns sunlight and soil into something the world can't live without. When currencies wobble and screens flicker red, a field of wheat doesn't care. It still grows. It still feeds. And someone somewhere still pays for it. That's the beauty of productive land. It doesn't just sit there hoping to be worth more. It works. It yields. It produces value that no central bank can counterfeit. You can rent it out for steady income or hold it long term and let the harvest compound. Because while cities expand, the supply of good soil doesn't. Each year there's less of it and more mouths to feed. That imbalance between scarcity and necessity is what gives farmland its quiet power. It doesn't move fast, but it rarely moves backward. When the dollar weakens, when inflation rises, the price of what farmland produces usually rises too. That's built-in insurance, not speculation. Corn, soybeans, wheat, they all speak the same universal language: demand. But farmland isn't for gamblers. It's for patient owners, the kind who'd rather grow wealth than chase it. Weather, pests, and market cycles will test you, but the earth rewards discipline in a way the market never will. And maybe that's the deeper lesson here. Farmland isn't just an investment, it's a reminder that wealth isn't made by prediction, but by production. That real value grows quietly, season after season, long after paper promises have faded. When you own a piece of the earth, you don't just hedge against inflation, you feed the future. Every empire runs on the same ingredients: fuel, food, and metal. No matter how digital the world becomes, the real economy still burns oil, builds with copper, and eats what the earth provides. That's why commodities, the raw materials behind everything, act like lifeboats when currencies start taking on water. You can print money, but you can't print wheat. You can raise interest rates, but you can't mine copper overnight. And no central bank can quantitatively ease a barrel of crude. Commodities are the world's baseline of truth. They remind us that value begins in scarcity, not in spreadsheets. When the dollar weakens, it often takes more dollars to buy the same ton of steel or gallon of fuel. That's not magic, that's math. It's the natural reaction of real assets defending themselves against paper-losing power. But don't mistake them for perfect. Commodities swing like moods, driven by weather, wars, and whispers on trading floors. They're wild, volatile, and untamed. That's why the smart approach isn't to bet on one. It's to own the basket, a blend of energy, agriculture, and metals. Because while one crop fails, another thrives. While one mine closes, another delivers. Through broad exposure, funds, partnerships, or indexes, you're not gambling on a single spike. You're holding a quiet claim on the essentials of civilization, and that's the key: essentials. When inflation bites, when money slides, the world doesn't stop eating, driving, or building. That constant demand gives commodities their stubborn resilience. They may not throw off cash like businesses, but they hold the kind of power that only reality can. In the end, commodities are like tools in a shed, not flashy, not fragile, but there when the system fails. You won't need them every day, but when the dollar leaks, you'll be glad they float. Not every weapon in finance makes noise. Some just endure. While investors chase excitement, the smartest money hides in silence, earning slowly, defending constantly. That's the job of inflation-protected bonds. They're not glamorous. They won't double your wealth overnight. But when inflation creeps in, when groceries cost more and dollars buy less, these bonds quietly adjust, shielding what you've already earned. They're simple by design. A normal bond pays you interest on a fixed amount. An inflation-linked bond changes that amount as prices rise. When inflation ticks up, your principal grows, and your interest grows with it. It's like a rent agreement that automatically updates when your landlord, the economy, raises the cost of living. No arguments, no guessing, just built-in protection. You don't need to be a market genius to own one. You don't need a Bloomberg terminal or to predict next year's CPI. You just hold it, and when inflation shows up, the math does the rest. And because these are backed by the U.S. government, their credit risk is nearly zero. They're not lottery tickets, they're life vests. You won't get rich holding them, but you'll stay afloat when prices rise and paychecks lag. There's even a quiet beauty in their structure, a fixed rate that stays the same, and a variable rate that dances with inflation every 6 months. Together, they create stability in motion. Taxes might nibble at the edges, and returns may seem modest, but that's missing the point. Their job isn't growth, it's preservation. They're the concrete slab under the house, the foundation that lets you build higher without fear of sinking. In a world addicted to risk, these bonds offer the one thing no one else can promise: predictability. They don't fight inflation with drama. They fight it with discipline, quiet, steady, unshakable. When the storm hits, they don't rise above the waves. They keep you from drowning. Some assets don't fight inflation, they dance with it. While markets panic and currencies slip, real estate and infrastructure simply adjust their rhythm, raising prices in step with the world around them. That's the quiet genius of the essentials. People might skip vacations, delay upgrades, or stop investing, but they still live somewhere, use water, drive roads, and turn on lights. And the owners of those systems, those who hold the infrastructure of daily life, don't just survive inflation, they profit from it. Think of an apartment building. Every lease renewal is a tiny inflation hedge. When living costs rise, rents rise too. One contract at a time, your income quietly realigns with reality. Or picture a toll road or utility company. Their rates often rise by law, linked to inflation indexes built into their agreements. It's not greed, it's protection. When costs climb, so does the revenue, keeping the business steady while others wobble. That's the strength of regulated infrastructure. It's the economy's backbone, built once, lasting decades, and often guarded by governments who need it to run. Of course, not every roof is stormproof. Bad management, political pressure, or over-leverage can weaken even the strongest foundations. But when chosen wisely, these assets offer something rare: cash flow that adjusts instead of erodes. Over decades, as populations grow and cities sprawl, demand rises, not because of market hype, but because people keep being people. They live, move, and consume. That steady, almost boring rhythm is what gives real estate and infrastructure their quiet power. They may not skyrocket, but they rarely sink. In a world where money melts a little every year, these are the walls that hold their shape, the roof that raises itself when the storm rolls in. So when others chase noise, you can own the silence, the apartment, the tollway, the pipeline, and sleep under a roof that adjusts itself while you rest. When storms hit, everyone runs for shelter, and in the financial world, that shelter often has a flag on it. Not all currencies are created equal. Some leak faster than others, and a few, like the Swiss franc or the Japanese yen, seem almost designed to stay dry when everyone else is soaked. These are the strong havens, currencies with a reputation for calm, earned not through luck, but through discipline. Switzerland runs its books like a cautious family. Low debt, steady budgets, no drama. The Japanese economy moves slow, but it's built on deep savings and loyal creditors. Neither is perfect, but when chaos spreads, investors remember who panicked last time and who didn't. That memory becomes gravity. Money flows toward stability, toward currencies that don't print endlessly, don't default easily, and don't gamble politically. Holding a slice of wealth in these currencies isn't about chasing returns. It's about owning calm in a noisy world. A few months of cash or short-term government bonds can act like an anchor when your home currency starts drifting. If the dollar weakens against these stronger peers, the value of your holdings quietly climbs, not through growth, but through contrast. Their strength reflects your protection, and when panic fades, you can convert back, using that stability as dry powder to buy assets others abandoned in fear. Of course, you don't move your life savings into francs or yen. Too much safety turns into stagnation, but too little, and you'll be the one chasing lifeboats when the tide turns. Strong currencies don't make you rich. They make sure you're still standing when everyone else starts counting losses. Because in the end, money isn't about excitement. It's about endurance. And sometimes, the smartest move you can make is simply standing where the ground doesn't shake. Every market cycle creates two kinds of people: those who chase and those who own. The chasers predict. They obsess over headlines, trade on emotion, and measure success by weeks, not decades. The owners? They understand that survival is strategy, because money, like nature, rewards patience. It flows to those who build shelter before the rain, not those who panic when it starts. Look back at every empire, every collapse, every recovery. The pattern is always the same. Paper changes, confidence resets, but real value, ownership, endures. Farmland feeds, infrastructure runs, commodities power, gold defends, and the disciplined mind endures it all. That's the mindset of the owner. They don't try to outrun inflation or outsmart policy. They prepare quietly, allocating, diversifying, balancing, not because they expect disaster, but because they respect possibility. They see every asset like a part of a fortress. Gold is the wall, farmland is the field, bonds are the moat, and strong currencies, the gates that hold firm when panic pounds. Most people lose wealth not from ignorance, but from impatience. They want to time storms instead of designing roofs. They chase thrill instead of building safety. But the true game of money isn't about prediction. It's about protection. The owner's mindset doesn't fear volatility. It welcomes it, because volatility is where weak hands sell and strong foundations prove their worth. So stop trying to be a prophet. Be a builder. Be the person who wakes up calm, while others refresh charts and count losses. Because wealth isn't what you make when times are good, it's what you keep when the bucket leaks. And if you've built with discipline, patience, and purpose, you won't need to chase the next trend. You'll already be standing in the house that others wish they hadn't sold. In the beginning, we talked about a bucket, one that leaks slowly, silently, drip by drip. That bucket is every currency ever created, every dollar, every pound, every franc. Each one starts full, and each one, over time, begins to lose a little more. Not because of failure, but because that's the nature of paper promises. But there's another kind of wealth, the kind that doesn't leak. It's built, not printed, earned, not borrowed. It lives in land that feeds, in tools that work, in bonds that hold, and in the discipline of those who think in decades, not days. The secret was never to chase the next wave. It was to learn how to float when the tide turns. You can't stop the bucket from leaking, but you can build one that lasts longer, one made of patience, ownership, and truth. Because real wealth isn't measured in what you make, it's measured in what survives the storm. And when the water settles, the ones who built with purpose will still be standing, their buckets full, their peace intact, their legacy quiet, but unbreakable.